Hello everyone, and thanks for joining the Summer WebEx Series hosted by Liquid Holdings Group. My name is Robert O'Boyle, and I'm joined on the call by my colleague Joe Dillman, who's a product manager of our front office solutions. So just a little bit on myself before we get started. So I've been on the technology and services side for the buy side for 15 years. I am the president of Liquid Holdings, and we're really focused on the technology tools and the services needed by hedge funds to support the middle and front office solutions and requirements of the hedge fund marketplace today. So as I mentioned, this is the first of our two WebEx webinars that we'll be doing over the next 4 weeks. And what we've done is we've taken a look at some of the key issues in the hedge fund space today, and we'll be delivering a consolidation of findings both from ourselves as well from our clients. If you have questions on the content, please feel free to email them to marketing@liquidholdings.com, and we'll do our best as well as to answer any questions that you have during the Q&A session at the end of our discussion. Also be sure to follow us at Liquid Holdings Group on both LinkedIn and Twitter. Today we plan to spend about 45 minutes discussing the hedge fund industry as it exists today, what characteristics drive allocation.
Can you guys hear when I talk?
Yeah, if everybody could just mute themselves, that would be great. Right. So we're going to talk a little bit about the changes in the hedge fund industry today, what fund characteristics are driving allocations from the institutional marketplace, what factors are preventing allocations to hedge funds, how hedge funds can level the playing field, and how hedge funds can use technology as a differentiator. Our goal today is to arm you with the different tactics to convey your fund's processes, performance, and the alpha generation activities that you have, and to prove that they're repeatable. It also will show you how to showcase what's driving your performance and what will continue to drive your performance as market conditions change. And lastly, how you can enforce your investment and operational policies, your automated controls, which is a key component of the institutional allocation today. You know, these are 3 points that are key to winning the DDQ process. As we know, the ability to raise capital is key to supporting a quality investment team and a reliable operations. Probably more importantly, not having the capital to invest in your business means that individuals within hedge funds spend more time away from managing the performance and more time trying to find capital. So where I thought we would start is the change in the hedge fund landscape. And this is pretty much a good news, bad news slide. But what you see here is at the end of a very nice run between 2002 to 2007, we saw a relatively significant reduction in assets into the hedge fund space. This came through the global financial crisis, and it caused a major shift in who was allocating money to hedge funds. And so what you see here is really in 2008, a fairly dramatic change in where the assets to the hedge fund space came from. And what you see really from 2008 all the way through today, 2015, and on past that to 2018, 2020, is a very, very dramatic change in where the assets to the hedge funds are coming from. And so you can see that the assets are estimated to be in excess of 4 to 5 trillion within the next 3 years. And today, the institutional asset allocator make up the lion's share of the assets coming into the hedge fund space. And so what we see today is that there is, given the quarter, essentially 3 trillion assets under management globally by the hedge fund community. That's created an expansion of organizations looking to get access to those assets. So there's now over 10,000 hedge funds globally. The lion's share of the assets within the hedge fund space goes to the largest hedge funds, firms like D.E. Shaw and others, Eaton Park, but it still leaves 300 billion assets remaining for the other 90% of the space. And this is a very interesting number because at the beginning of the growth of the hedge fund space, 300 billion is essentially where the market started. And so there is $300 billion up for grabs for these funds that are smaller than or newer than the top 10 of the hedge funds. And it's really no surprise that the institutional investors have favored the largest funds, in part because they have the infrastructure in place to safeguard the assets. What does come into surprise here is that these institutions are continuing to allocate smaller but significant portions of money into the smaller funds. One of the reasons why they're moving into the smaller funds is because many of the larger funds are closing access to the new funds that they're starting. And so what you're actually seeing is a trickle-down effect comes into play. And as an emerging manager, you can expect the pool of $300 billion to grow. What's interesting is, the institutions allocated over almost $20 billion in net new capital to the alternative space in the first quarter of this year alone. And a Preqin report showed that 27% of fund managers are planning to launch a new fund to try to take advantage of these assets. So the summary, the largest hedge funds are certainly getting a very significant portion of all of the assets because of their experience and because of their infrastructure, but there remains a very significant amount of assets for the smaller funds, and the question is, how do you get access to these funds? And so when you look at where the capital is coming from, what you see is there are almost 5,000 institutional investors relying on hedge funds to diversify their overall investment strategies. And you can see that pension funds and private sector pension funds make up the lion's share of this, with sovereign wealth funds and endowments and even asset managers picking up the remaining 30%. And the good news is, for a hedge fund, all of these segments are continuing to plan on growing their assets into the hedge funds. So it continues to be an area of growth from an asset space. If you look back 5 years ago, investors essentially asked questions only about performance and pedigree. And so that worked out well for many individuals who had experience, had a proven investment team, had a philosophy, and had great performance. But as the institutional community continued to look into finding managers to allocate money to, the criteria changed for manager selection. And this is really what we're going to talk about over the next few minutes today. And so beyond performance and beyond the investment team, or the pedigree, if you will, the concept of data accuracy, transparency into the investment process and into the overall performance, as well as the ability to reduce fees and, most importantly, manage risk and to be able to demonstrate risk processes. These have now become the critical 5 factors for selecting managers. And this is, in fact, the crux of what everybody calls institutional quality investment managers. So if you don't have, or rather, if you have performance and you have pedigree, but you're running your organization on Excel and manual processes and a handful of non-repeatable tools, it is very unlikely that you're going to be able to get meaningful allocations from the institutional community. And what really demonstrates this is today, virtually every DDQ in the industry has sections dedicated to processes and infrastructures, and that really didn't exist as recently as 5 years ago. So what we did is we took a look at some DDQs from 4 large institutional allocators, and we broke out some of the DDQ questions on a number of categories. And there are sample questions here that we pulled directly from them. And again, the DDQ process is the process in which allocators go about determining whether or not a manager is qualified to manage the money. So even if your performance is stellar and you have a great track record and you've got real experience, if you cannot pass the DDQ process, you're not going to get an allocation. What's also interesting, as I mentioned before, given the fact that there are over 10,000 funds, there's a tremendous amount of work that an institutional manager or consultant that works on behalf of that institutional manager has to go through. So what we've heard from our clients is it's oftentimes a one-shot opportunity that if you don't pass the due diligence process of the institutional allocator when they come, it's very unlikely that you're going to have another opportunity anytime soon because there are so many funds that the institutional allocators need to take a look at. So it really is critical that you're able to present yourself and show well in the DDQ process. So here, the first section of the DDQ sample questions come in the flavor of execution. And so a handful of the questions that we pulled was, describe the trading limit and processes that your organization run. Is there a restricted list process? Describe the decision support analytics used. What is used to view your positions and your P&L on a repeatable process, both historically as well as real time? And how do you consistently trade, how are your trades allocated across all accounts? And so if you're not able to show specific and repeatable processes and technology and applications to support the execution activity, you're not going to be able to pass this section of the DDQ. The next one, and it's probably more important, admittedly, is around portfolio management and risk management. And so questions like, how is capital allocation adjusted? What determines the size of each position? What are the main risk measures that your fund uses? What's the process to liquidate positions? And how do investors access reports? So again, these are fairly detailed and fairly specific questions that can only be answered with true processes. This is a relatively newer area, one that actually has a focus both for internal processes as well as outsourced processes, and it really does focus on operations and now the middle office. And so questions like describe processes for reconciling trades, describe processes for handling trade breaks, how do you shadow your fund admin? This is actually something that's relatively new. Historically, institutional investors would use the fund admin as the primary source of validating the NAV or validating performance of the hedge fund. And now what you're seeing is the institutional investors actually want the fund themselves to be able to shadow the fund admin. This is both on a monthly basis, and oftentimes we're seeing institutional investors looking to be able to see the NAV on a daily basis as well as any, potentially a real-time basis. How do you describe your business continuity and DR plans, and how do you describe provisions for data backup? So again, as a small organization, and this definitely is a good example of where the larger funds have an advantage over smaller funds because they've had the opportunity both from a time frame as well as an investment standpoint to put in strong business continuity plans to be able to demonstrate that they can manage the investors' money in good times and bad by being able to access the data and access the systems for trading purposes through any type of situation. And this is more than just, are you backing up your data? This is actually, how do you run the fund during a hurricane? How do you run a fund during a geopolitical event? That's a requirement on the institutional side, and quite frankly, is not as important when money is coming from friends and family. So, the punchline here is that, if you want to raise capital through the institutional community, if your performance is something that is of interest to the institutional community, you need to make a commitment to the technology and the infrastructure and the processes to meet those institutional requirements. And so these are really 5 bullet points that continually come up both with our clients as well as our prospects, and definitely summarize the DDQ process. And so this concept of zero compromise transparency, the ability to answer institutional investor questions when they ask, whether it's over the phone or through reports, the ability to convey your funds processes, how you generate performance, and to prove that processes and performance are repeatable for all intents and purposes in good times and bad. To be able to clearly showcase or clearly articulate where the performance is coming from and how that performance will change as market conditions change. To be able to show how you can enforce investment and operational policies through automated controls. So beyond just we try real hard, but to show how the system will protect their assets. And ultimately, you need to be able to do this in an environment that is not terribly costly, so that you have the ability to compete on fees, which is now one of the key considerations in allocating money once the DDQ process has been validated, and once the performance and once the strategy has been performed with the thousands of funds that are available. The ability to compete on fees after everything else has been vetted through is a really significant issue. So there is more money out there. However, it is harder to get to, and the competition is fierce. So what I thought we would do is demonstrate a couple of examples of how we, and this isn't a sales pitch, it's just showing how our approach and many other technology provider approaches work to help hedge funds drive what we would consider differentiation through technology. How you can meet the DDQ requirements, how you can implement the institutional infrastructure, and show how your organization could be better at not only growing the wealth of the institutional investor, but also protecting it during volatile times. And so from a pre-trade risk and execution standpoint, products that can provide automated execution approaches, the ability to help you find the best broker for your strategy, the tools that allow you to optimize trade routes so that you can kind of trade anywhere for optimal execution, the ability to analyze performance in real time, and the ability to demonstrate through audits and systems how you allocate trades in a compliant manner so that there's no favoritism within your organization. From a portfolio and risk management system, the ability to have a system that can isolate the drivers of performance, run that performance in the P&L and the risk analysis on a real-time or historical basis, to be able to model the liquidation process, the ability to see exposures, and something that continues to grow in importance for the investor community at large, the ability to access not only reports but data through investor portals. So that's just a fancy way of saying the ability to get access on an ad hoc basis through the web. And then this is something that we continue to see interest in, the ability to leverage best practices within the industry. And so this concept of outsourcing start of day and end of day processes, including reconciliation, how to shadow the NAV of the fund administrator, and how to outsource those business continuity and DR issues so that your organization doesn't have to be an operations and IT footprint heavy organization, but that you're able to continue to show this institutional infrastructure. So what we in effect have built and what our clients use at Liquid is a unified platform that spans the front office, that simplifies the access to the data, not only for decision-making processes, but also for the end investor. And so we don't do everything for everybody. However, we do focus on simplifying the access to everything from the pre-trade compliance all the way through execution to real-time risk and reporting, which is really what we're finding to be a key driver in smaller funds winning larger portions of the institutional allocations. We do this all through the cloud, which eliminates the need for internal hardware and internal IT. So what I'd like to do now is actually just pass the baton, if you will, over to Joe Dillman, and what he can do is walk you through the application, again, not from a demo standpoint, but to show how hedge funds like yours can get access to the information that they need and to demonstrate the tools that they need to demonstrate to the institutional community to drive assets in their direction.
Thanks, Robert. Going to pick up from there and just kind of walk through how we set up a way to view data that gives you an ability to meet the requirements to receive capital from institutional organizations. So everyone at this point should be able to see the Liquid Mobile dashboard. Liquid Mobile is a responsive web-based app that extends mission-critical analytics onto any mobile device. And as compared to a static pitch book, modern technologies like ours allow CIOs and portfolio managers to communicate the drivers of risk, performance, shadow NAV with investors, right from an iPad. So on a desktop, on an iPad, an iPad mini. As important, the historical portfolio and market data that's powering our analysis is maintained on your behalf. This is the dashboard, and from here you can customize a view from a library of metrics and place them in an arrangement that makes the most sense to you. Here I've created a portfolio summary that you might use with an investor to convey the performance composition and risk-return profile of your fund as of right now. Or we can do it on a historical date that you specify. When we expand some of the dashboard widgets, we allow some deeper dives into the data. Here, the portfolio summary widget shows metrics that substantiate the NAV or mark-to-market value of your fund, as well as other key data points with potential investors. This goes a long way in proving that the most important aspects of your business are calculated by a third party, objective source, and audited for accuracy. As we scroll through to sector exposure, we can see how your portfolio is exposed to the different sectors. This includes the ability to drill into the results and view how each holding in the fund contributes to that exposure. If we then look at yearly returns provides returns for the fund on both a monthly and yearly basis. So we can toggle between the two. From here, you can view the returns over different time horizons and since inception. You can also augment this with a monthly view of performance that provides investors with a more granular view of how you're performing month over month. After viewing your performance in absolute terms, the benchmark performance widget allows you to compare your performance against the benchmarks that you and your investors select, again, over different time horizons. As we look at performance statistics, again, building off of the benchmarks, we show some fundamental analysis that provides investors with an understanding of the portfolio's risk profile for standard deviation, annual return, Sharpe ratio, beta, alpha, any of these statistics. And again, we are comparing the fund to the benchmarks that you've selected. If we want to get a view for what's within the portfolio, the top gainers widget shows insight into the top holdings contributing to the fund's performance. And here we can drill into the top 5, the top 10. We can look at all of them and see where our gainers and losers are separated. And finally, the sector heat map provides a view of the performance across the sectors that are held within the fund. Using a modern tool such as us to supplement the pitch book helps to answer questions about your business at that very moment, and being able to do so while away from the desk demonstrates best practices in client management. And the fact that the data and resulting analysis are accurate and auditable and provided by an objective third party will differentiate your fund from an emerging manager looking to grow their asset. As the conversation with potential investors moves from a summary of your fund to what repeatable controls are in place, I'd like to walk through a few reports that help show how to monitor your investments. Working with a $100 million new launch here in the States, we built this view with their CIO to actively monitor the performance of its master fund as well as several SMAs. Stats such as the NAV, the total P&L, the net long and short exposure, these all detail how the portfolios contribute to P&L over different time horizons. This includes intraday monitoring to model the impact of current market conditions and new transactions have on the fund as new events are confirmed within Liquid. This report is put into practice when the CIO receives a call from an investor who wants to understand the contribution to today's performance of all longs or shorts or specific holdings in the portfolio. Tools such as ours make this information readily available, and this can be recalled on the current date or any previous date. And this type of interaction and the repeatable controls shows institutional investors what they expect from their partners to address their transparency requirements. If we look at something like equity exposure by market cap, this is another report to actively monitor the fund's exposure. In this case, a CIO or a portfolio manager would rely on this to understand what percentage of the fund is made up of large, mid, and small cap companies. More granular analysis on the number of positions in the long, short, gross and net market values by symbol are made available to handle more granular conversations. We provide stress test capabilities as well, and these allow you to communicate how your fund would perform during an extreme event, such as the Asian crisis or Black Monday or the Gulf War of 1990. And as you deal with more savvy investors, you can also model a fund's reaction to changes or shocks in external factors, such as fluctuation in FX or interest rates due to Greek bailout or investor expectations that the Federal Reserve are going to raise interest rates or something like that. Liquidity and how you're managing is also very, very important. And after understanding how you monitor the fund, the next question posed during the DDQ will be on the processes in place to liquidate holdings. The equity liquidity report enables you to deal with the stringent liquidity risk requirements that are front and center on these DDQs. This report illustrates the impact liquidating the fund would have on its gross, net, long, and short market value, and the percentage of the fund that can be liquidated immediately as compared to the percentage that would liquidate over a longer time horizon. Drilling into the results provides you with some specific holdings or information on specific holdings that would have the largest positive and negative impact on the fund's value. This type of analysis is generally helpful to proactively discuss the process and the optimal time horizons to liquidate assets if and when requested. And last but not least, performance is always important. And leading up to the performance attribution by sector report, you've demonstrated that repeatable controls are in place to handle larger pools of assets and stricter transparency requirements. This has allowed you to level the playing field against the billion and above club that point to infrastructure as a differentiator. So now you can focus on your performance. Here we're breaking it down by sector, and the symbols are holdings that roll up into each, and which ones are having the strongest positive and negative effects in the value of your fund. The granularity of the analysis allows you to tie performance back to your investment policy and discuss the processes for allocating assets to a particular sector or symbol in the future. The dashboards and reports that we've just covered are a sample set of the analytics available today from either your desktop or a mobile device of your choice. Presenting your business this way helps provide you with more fluid discussion points about your fund during the capital raise process. So our goal has been to give you a modern tool to present the information where you have full access to the underlying data in case you need access to granular data in order to justify your results today or historically. 5 years ago, your fund would have incurred substantial costs to link together performance, market, and liquidity risks along with shadow NAV calculations into a single environment. The intraday and mobility were probably both out of the question. Those were a little early in the process. The technologies weren't there yet. If we fast forward to today, modern tools are allowing you to market your fund to investors through a number of different environments or an app, in this case, that provide the most granular and up-to-date details about the business while allowing your investor to sort of tick the institutional controls box Robert was mentioning. It's part of the DDQ process. And this is a quick overview of how we do it. I'll be available after the discussion ends to field any questions you might have on analysis or any reports of the data, but for now, I'll turn it back over to Robert.
Thanks, Joe. So the next piece, actually, before I go into this, I think, Joe brought up a very valid point, and we see it over and over again. So a lot of the data, while the presentation is strong, a lot of this information can be available and has been available to the marketplace in the past. It has come through the utilization of legacy-based technology. That legacy-based technology has been expensive to procure, expensive to implement, and expensive to maintain. And so oftentimes the smaller hedge funds were left with a chicken or the egg scenario. Do I spend a large portion of my fees that I'm generating into technology, or do I put that into my fund itself to try to generate more performance? However, what we are seeing, and it goes all the way back to that first slide, is that in order to attract the institutional capital, you need to make that commitment up front. And it is one of the reasons why organizations and technology providers like Liquid have been popping up, because as Joe pointed out, the technology that we can use today to deploy and deliver applications is much stronger than it has been in the past, and allows us to offer it at a much lower cost. And so what I thought I would do before I open it up to questions is provide just two examples of two of our existing clients and the ROI that they were able to take advantage of through the implementation of infrastructure. So typically people think of the implementation of tools and systems as a cost, but really the nature of this presentation and our position in the marketplace is that infrastructure is a way to grow the fund, and infrastructure is a way to reduce your overall costs. And so the first fund that I wanted to provide an overview on was a $250 million long short. They had three commingled funds plus some managed accounts that they managed independently. And they had a very strong pedigree, and they had a proven track record. However, they were grappling with how to expand out their investor reporting and grappling with how to get the analytics to the institutional consultant that were supporting the institutional investors. This organization was still in heavy asset growth mode, even though they had $250 million. And so the concept of mobile access that Joe was talking about, the ability to access the fund in real time through a tablet, was an important part of where they were trying to take their technology. They did have systems in place, but none of them were real time, so it limited their ability to answer the investor questions when they came up. And they were spending more and more on technology, which was eating the profitability of the fund. And so they implemented Liquid, which gave them a comprehensive front office tool set that allowed them to get to the real-time analytics that they were looking for without the IT and without the footprint that we've talked about before. And they were confident that this structure would allow them to institutionalize their organization to better meet the questions within the DDQ and the questions that were coming from the consultant community. And ultimately, they were able to dramatically reduce their technology costs. So they were spending in excess of $200,000 a year, and they were able to reduce that down to 60, which was pretty significant. So that 140K can go back into the fund, or that 140K can go into a bank account. But that was 140K that they were spending just on technology alone. And within 12 months of implementing the system, they were able to raise another 30% in institutional assets. So it's a strong case study of what these type of tools, we're kind of partial to ours, but it is a demonstration of what these type of tools can do and enable organizations. The next one here is a much, much smaller fund. This is a brand new launch, just a couple of people. And the fund actually didn't have a track record, but the head trader and the CIO had a really great pedigree and a great proven historical track record. But as any launch would happen, they had no real front office system, and they had no way to take a look at the performance. And so they had no institutional infrastructure. And so for all intents and purposes, they're invisible. So despite the fact that they have good experience, they were not able to attract any attention whatsoever. And so they implemented our solution. They were able to automate a lot of the processes. They were allowed to focus all of their assets into capital raising and looking for organizations that would invest in their strategy. They could get away with a smaller technology footprint than the fund I showed previously, but it's still, that legacy approach would have cost them roughly $130K in technology, and we were able to do it at $40K, which is great. But the real impact here is that they were able to, within 9 months, dramatically raise capital because they had the history and they had the infrastructure, so they were showing the commitment to a long-term business, and they were able to pull in 3 institutional allocations within that 9-month period, which really took them up to really close to that $100 million mark, which is a really key watershed moment for any hedge fund going through the process of growing their fund and getting on the radar of the institutional community. So, you know, this is just, as I said, the focus here was we identified, you know, the reality that it is a very competitive space because there are so many funds with some experience, with a track record, and there is a much more significant level of analysis that the institutional community is doing. It's actually great news because there is money available, but there is very little tolerance of the institutional community to allocate assets to hedge funds that aren't demonstrating the commitment to the business through the implementation of infrastructure. And without this infrastructure, it limits that fund's ability to manage performance in periods of good time and bad. It limits their ability to show repeatable processes. So the $300 billion continues to grow. Winning the allocations really does come down to knowing your investor and the manager selection process. Knowing your investor is understanding what the key requirements are of the investor, and in this case, the institutional community wants certainty and systems. As I mentioned before, it's widely accepted that you really only get one crack, especially as a small fund. When you're larger, you get lots of cracks at it, but you only get one good opportunity to demonstrate your fund's capabilities through the DBQ process. And with the right infrastructure, you can then focus on the performance, the investment policy, the investment team, which does then allow your product and your fund to shine. So with that, I'll open it up to any questions that anybody might have. All right. So one question here is, how do you get access to my portfolio data? So the way it works is that upon initiation, we load up your portfolio funds. We get that from your prime broker or your fund administrator, and then from then on, you're actually using one of our components called Liquid Trade to execute to your prime brokers, to whatever exchanges you need, and that information is flown automatically into our system through the executions. And then on a nightly basis, we go ahead and reconcile your fund positions against the prime brokers. One of the questions is, how does your system deal with privates? So you're able to book any type of investment, whether it be OTC, private equity, fixed income, into our what's called Liquid Metrics, which is the risk and reporting engine. So you enter those in on a manual basis, or if you have a lot of non-listed investments, we can import those through direct file uploads. So another question, and I'm glad that it was asked, is what is the pricing like for your system? So it certainly depends on the size of the organization, and it's certainly something that has variabilities. The variabilities come into what level of specialized reports, as well as what's the level of managed services that the hedge fund uses. But our average client today pays anywhere between $40,000 and $75,000 on an annual basis for execution, real-time risk reporting, and the managed services. Another question is, does your system take into account FX rates? Absolutely. So you can think of our platform in particular as a global listed platform. So we handle equities, options, futures, Forex. It is a global platform, so you can purchase in one currency and settle in another. One of the questions was, do you work through your clients through the DDQ process? We don't necessarily work with our clients through the DDQ process, but we have had clients that have come to us and asked specificity around how to best answer the DDQ process when it comes to the technology to make sure that they're answering the DDQ questions accurately and completely. So we have we are a small new company. We have a very close relationship with our clients, and we're happy to provide any level of clarity and assistance across the investment process. Another question here, thank you for asking, is if we have a customized risk model, can you integrate that into the reporting? Absolutely. So the Liquid Metrics product has a series of custom calculations from a risk standpoint, as well as the ability to import and automate customized risk models. And as Joe was showing you earlier, that's a key component of being able to validate your performance and your risk parameters. So yeah, we can certainly implement customized risk models and institutionalize them into the system so they're not just being run out of Excel. One of the questions was if I'm only interested in risk and nothing else. So the Liquid platform has three components to it: the OEMS, or execution and order management, the managed services, and our risk and analytics platform. So you can certainly, and we have clients who do this today, just subscribe to the metrics or the reporting engine, and we will pick up drop copies from your EMS. EMSX is one that many of our clients use, and so that would feed the data engine, and you'd be able to look at just the reporting. So yes, you can buy just the risk module. So a question came in on the side of reconciliation. So how does your system handle trade breaks? So part of our overall platform is a solution called Liquid Managed Services. The Liquid Managed Services is actually a team that handles the reconciliation, corporate actions, dividend, as well as the posting of fees and accruals for NAV purposes. And so when we have trade breaks between the information that we know on behalf of the client or the client knows against the prime broker, we go in and research that on behalf of the client, reach out to the prime broker, understand where the issue is, and then correct that issue. So another question is, if we use your product, do you have preferred prime broker, back office, et cetera, that you would be able to recommend? So we are a broker agnostic, market neutral platform. We certainly have some prime brokers where we have more clients than less, and would be happy to introduce you to those. We are plugged into many, if not all, of the largest fund administrators from a back office standpoint that we can also recommend as well. So we certainly can point you to organizations that are already integrated with us. While we're always integrating into new venues, new PBs, new exchanges, new counterparties, the ability to work with an existing vendor is something that really speeds up the time to market. Okay, here's a question for Joe. Let me let him repeat it and answer it.
So I see here we've got a question, what devices can Liquid Mobile be viewed on and what OS limitations? So we built Liquid Mobile to be fully responsive. And what that means is the experience is optimized for your laptop or your desktop or your large screen. But it will also scale down to, your Apple iPad device or your iPad mini or anything. We've down to about a 7-inch device. And so when we build systems like this, we understand that the community uses what they like to use. And so we do have some Android users, and we have some iPad users, and we have people who like Internet Explorer or Chrome or whatever. And so we've tested it across all of the different environments, all the different operating systems, and all the different browser combinations. So it's a good question. There was one other question that I saw with respect to system security, right? So how do we protect your data, and how do we control access? So all of the communication in Liquid Mobile and with any of our web systems is highly secure. So we have what are called secure certificates and secure protocols that we use to manage all of the information and transactions. From the back end, what we also do is our data centers are fully redundant, and access to those data centers is controlled so that only certain individuals within our organization only, have access to the actual devices that hold any of that data. So there's a number of layers that go all the way from the app. So if you have your iPad and you try to log into it, we have your classic user ID and login information, but all of the communication and the traffic between that device is encrypted to our back-end server. And then, of course, when that information is back in those servers, the amount of, the very few people that actually have access to it and the amount of security controls that are there are classic sort of network operations kinds of things, fingerprint scanning, retina scanning, things like that. A couple more questions for you, Robert.
Okay, let's see here. I'm just pulling questions here, so everybody just bear with me one sec. So there's a question here. How do you recon the activity and portfolio in real time? Are trades done through your platform? So as I had mentioned before in that very brief illustration, what we have is a unified data structure that pulls in trade information in real time from an execution standpoint, either from leveraging Liquid Trade, our own OEMS, or through other vendors such as Bloomberg's EMSX. That comes into through the concept of a drop copy, which is a real-time update. That information flows into the data structures, and from a reporting and risk and portfolio position standpoint, the incoming information, the executions are updating the database, and all of the calculation engines, whether it's performance, whether it's attribution, whether it's a VAR engine, whether it's other risks, those are persistently deriving or persistently banging against the primary database, and that's what enables us to generate the information on real time. As I had mentioned before, on a end-of-day basis, we reconcile with our clients' counterparties, whether that be prime brokers, fund administrators, or others, to ensure that any additional activity within the fund is updated. And we do that through our Liquid Managed Services team. So if there are corporate actions, dividends, accruals, fees, all of that is updated, again, into the database and keeps the portfolio accurate. There's another question here on price. So as I mentioned before, a typical client of ours on an annual basis through a monthly subscription pays between $40,000 and $75,000 a year on the platform. We do have the ability to create custom reports. That's typically done on a time and materials basis. The good news with a solution like Liquid, one that is a SaaS or multi-tenant cloud-based application, is there is no hardware, there is no disaster recovery costs, there's no redundancy costs. It's all built into the solution that we have. And with our approach, you're not required to spend IT dollars or operational dollars. That's what the managed services component does. So that's where our clients get a tremendous amount of savings. So another question here is, what if any shortcomings are there to using your products as compared to building out reporting in-house? I think, you know, for many, many years there was a concept of buy versus build, right? And so by building it yourself, you have the opportunity to create a highly customized solution that's very tailored to your organization's investment policy and reporting needs. I think we're at a stage with the rapid transformation in the investor space that there's much more of a mentality of buy or die. And what I mean by that is if you invest your funds in building reports that are largely accessible through technology vendors, you'll divert your own internal resources, you'll spend money that should be invested, and you will probably get a 10% customized benefit where 90% of it you could have done for much less cost through the solution. So as an example, a quote-unquote shortcoming of the Liquid platform is that we don't have a vehicle to electronically trade fixed income. So if you have a portfolio that has significant fixed income positions, from a trading standpoint, this might not be the right platform for you, but that would be an example of a shortcoming. So it is 3 o'clock, and I do definitely want to be sensitive to the time. And so what I'd like to suggest is down below are 2 ways to get a hold of us at liquidholdings.com as well as at LinkedIn. And please contact us directly, and we'll have somebody call you to answer any additional questions that you may have. I definitely appreciate everybody's time and participation, and hope you got something valuable out of the webinar. Thank you very much.